Welcome to The Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to The Weekly Option. This is episode 252 on January the 6th, 2023. I'm your host, Eric, and in this week's show, we will cover the trades from last week on TG Therapeutics, Southwest Airlines, and Barrick Gold Corporation. And we discuss three new trades on Marathon Digital Holdings, Verizon Communications, and Intel Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to me at eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on the show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for The Weekly Option. I also teach students how to trade options, not just study theory, with the combination of videos and live coaching calls. If you're ready to take your trading to the next level, send me an email to schedule a phone call. The equity market started the year off with a small gain this week. The Dow Jones Industrial Average grew 483 points, closing at 33,630 points. The S&P 500 index gained 55 points, ending the week at 3,895 points. And now it's time for the topic of the week. And the topic of the week this week is low risk versus low probability trades. There's often a perception that low risk trades are the best. You can't just look at risk in and of itself. You have to consider the probability of achieving the desired outcome in order to get a complete picture. Let's say you define risk as the amount of money that could be lost on a trade, how much you could lose. In this scenario, the lowest risk trade you could put on is buying a cheap out of the money option for a dime. That would be $10 in real terms. That's actually pretty low risk in dollar terms. However, the likelihood of that trade finishing in the money is extremely low. In fact, in many situations, you're guaranteed to lose that $10. This might lead you to say, well, why don't we just sell the $10 option instead? Well, selling the out of the money option increases the probability of winning, but the amount at risk when selling a call option is unlimited. So that immediately breaks the trade filter if you want to avoid losing everything and going broke. So I focus on spreads because they're a way for me to put on higher probability trades that still have a capped risk and reward profile. I'll probably spend the next few weeks discussing other trade strategies and discuss them in the framework of risk versus probability of winning. That framework tends to help people make better decisions, and it's always good to start the year thinking about risk. So let's get into the trade review from last week's trades. We're going to start off with a covered call on TG Therapeutics, symbol T as in Tango, G as in Golf, T as in Tango, X as in X-ray. At the time, the stock was trading for $11.83 per share. I looked at buying stock and selling the January 12 call at $1.15, which could give us a return of 11.16% in 3 weeks. Well, TG Therapeutics shares lost $1.03, ending the week at $10.80 per share. The option we sold lost 65 cents, leaving us with a net loss of 38 cents if we were to close the trade immediately. Now, part of my consideration for this trade is that there are only 2 weeks left. I would typically look to wait a little while before making an adjustment, but this stock tends to move around a lot, and I'm not convinced that it won't rise up again. However, I will go ahead and look to roll the strike lower. I'll do this by buying back the 12 call and selling the 11 call at 65 cents. This will bring us back to profit by 27 cents. If stock finishes above $11 per share, we would lock in a total gain of 47 cents on the trade. That's still better than a loss, while still not as nice as our original goal for the trade. it would still be approximately a 4% return on capital in 3 weeks, which isn't bad. So if stock goes lower, I would continue to capture profit on the options and take in more premium by continuing to roll the strike lower and selling in future months. So the best part about using this strategy on lower price stock is that the big losses are still relatively small in dollar terms, and you might be able to make up for them with the additional option sales. Let's go ahead and move into the credit spread for last week. We looked at Southwest Airlines, symbol L as in Lima, U as in uniform, V as in Victor. Now, at the time the stock was trading for $33.67 per share, I looked at selling the January 34.5 call spread at 18 cents, which could give us a maximum possible loss of 32 cents per spread. Well, Southwest Airlines gained $1.41, ending the week at $35.08 per share. You can tell they got over their challenges from last week with regards to the delayed and canceled flights. The out-of-the-money spread that we sold is now fully in the money, which is a loss for us. With shares looking strong after all the negative news has passed, the stock still looks stronger. I would look to buy back the spread, locking in a loss of 18 cents. The main reason to buy it back and not just turn it into an iron condor is the fact that it is currently in the money and could lose another 14 cents with stock prices above $34.50. Now, I would then look to sell the January 34 put spread at 15 cents, which would lower our loss to 3 cents, although it does increase our risk to 35 cents. Or I would also consider selling the 33 put spread at 30 cents, which would increase my immediate profit and increase my possible loss to 70 cents. You certainly can wait a day or two before executing an adjustment on this one, but the clock is definitely working against us pretty quickly, with only 2 weeks being left to our trade and our original trade being in the money. And you can always choose not to make an adjustment as well, because we traded a spread. So you would just take the full loss of 32 cents on the trade, which was our original risk on the trade. So I always think that the best trade is the one that will manage and mitigate the risk of additional loss the best. But because we are trading spreads, we knew that we had a capped loss, a capped risk profile right from the start. And that's one of the things that makes it a little easier to sleep at night. Our final trade from last week, thankfully a win, was a debit spread on Barrick Gold Corporation, symbol G as in golf, O as in Oscar, L as in Lima, D as in Delta. Now, at the time the stock was trading for $17.18 per share, I looked at buying the January 17 call spread for 33 cents, which could give us a maximum gain of 17 cents, or that would be a 51.52% return in 3 weeks. Well, Barrick Gold gained $1.86, ending the week at $19.04 per share. The in-the-money spread that we bought is now even more in the money, and the spread will gain in value to the intrinsic value of 50 cents over the next couple weeks if stock remains above $17 per share. So this trade is definitely working out as planned. Given the shortened time frame, I would lead towards not making any adjustments on the trade and just looking forward to locking in that full return of 51.52% per spread. So this is definitely a nice job. If you were to make an adjustment, you could certainly make an adjustment that would capture more of the spread. You basically widen this out from a 50-cent spread to maybe a $1.50 spread or something along those lines, maybe even a $2 spread. We've talked about ways to do that in the past. If you don't know how to do that, or you want to be more comfortable adjusting and moving these trades around, shoot me an email and we could definitely have a call. It's what I love to do. And as always, just so you guys know, I really do enjoy listening to meeting my listeners. And, sometimes we talk, sometimes people decide to sign up for coaching, but coaching isn't for everyone. Not everyone's in that place where they're ready to do it. So I love meeting my listeners. If you guys want to meet me, want to get on the phone, want to discuss a trade, I really am available. So that's it for last week's trade review. This, of course, is our last week using the January 20th expiration for options. given the shortened time frame, each of these trades that we're going to take a look at today, since they only have 2 weeks left before expiration, they should be considered fairly high risk. Now, after this week, we'll start using the February 17th expiration for monthly options next month, but all trades today still expire on January the 20th, 2023. I've got to get used to saying 2023. All right, so we're going to start off with our covered call like we always do. This time I'm looking at Marathon Digital Holdings, symbol M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. That is M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. The stock ended the week at $4.09 per share. I'm looking at buying stock and selling the January 4.5 call at 24 cents, which could give me a return of 15.89% in 2 weeks. Now you enter this trade by buying stock for $4.09 per share and selling the January 4.5 call at 24 cents. This trade makes the most money if stock prices finish above $4.50 per share. The break-even price on this trade is $3.85 per share, and in real terms, the stock purchase would require $409, and you would collect $24 for selling the option. Next up, we have a credit spread. Looking at Verizon Communications, symbol V as in Victor, Z as in Zulu. The stock ended the week at $42.19 per share. I'm looking at selling the January 41.5 put spread at 19 cents, which could give us a maximum possible loss of 31 cents per spread. Now you entered this trade by selling the January 42 put at 88 cents and concurrently buying the January 41.5 put for 69 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices remain above $42 per share. The break-even price on this trade is $41.81, and you would receive, in real terms, $19 per spread that you sell and have $31 at risk. And our final trade for the show today is going to be a debit spread on Intel Corporation, symbol I as in India, N as in November, T as in Tango, C as in Charlie. The stock ended the week at $28.73 per share. I'm looking at buying the January 28.5 call spread for 32 cents, which could give me a maximum gain of 18 cents, or that's a 56.25% return in 2 weeks. Now you enter this trade by buying the January 28 call for $1.26 and concurrently selling the January 28 half call at 94 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $28.50 per share. The break-even price on this trade is $28.32 per share, and in real terms, you'll pay $32 per spread that you purchase, and your maximum gain is $18 per spread. So that's it for this week's show. Happy New Year once again. Welcome to 2023. And I hope this is an amazing year for you. I hope you've got some goals, some stretch goals, some likely goals, and something that's just going to help you push a little bit further for this upcoming year, whether it's in option trading or any of your other goals that you guys may have. I hope this is an amazing year for you. I'm certainly hoping that for myself. So if I can be a part of that, well, first off, thank you for listening to the show. That automatically makes me a part of your 2023. But if I can be a help in making you a better trader, definitely shoot me an email. I enjoy that. I really do love it a lot. So feel free to reach out. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.